So Mark, as an investor, what should we be more worried about? Viruses, Apple earnings, political swirl domestically with impeachment trials happening? I mean, there's a lot to choose from, and the narrative so far has been tied to the China virus. What do you think?
Well, how much time you got, Oliver? There's
about
there's
8 minutes, Mark.
I think what we're mostly focused on really is what's going to happen in the first quarter or the second quarter following what was a very robust fourth quarter, which was within our expectations. So to kind of make a long story short, we think the market is going to have a little bit of difficulty here in the first quarter. It may last into the second quarter, but we're overdue for some semblance of a correction. We got what we wanted from the fourth quarter, and we've taken a little bit of equity exposure off the table. So coronavirus, although the fundamental impact is probably unknowable at this point, it does right now kind of serve as a convenient excuse to sell down some equity exposure, in the face of valuations that have gotten a little bit stretched and some oscillating indicators that point to overbought conditions, at least as far as we're concerned.
Okay. Do you feel better about the market if, however, let's say, hypothetically, let's say Apple comes out and it's the opposite of what they did last year, and they say, guys, we got a great year ahead of us. The business is kicking on the services. We've got consumer demand, not just in the U.S., but around the world. They're buying the heck out of mobile devices, watches and stuff. If then that's a signal that we got our earnings to hold, can this market kind of shave off that valuation problem by growing its way out of it?
Perhaps. I don't know that there's enough underlying economic strength, whether in the U.S. or globally, to kind of give us the type of experience that we had, last year. Earnings, I think most expectations are probably 10% growth this year on the S&P 500.
Yep.
I think that's probably a little bit rich in terms of the way we think about it. So in an economic environment that's, stagnating, perhaps not going anywhere for the most part in terms of growth this year, I don't know that earnings are going to be that big of a kicker. So I think the economic rebound or the expectations of positive trade talk, manufacturing bottom, earnings that are not falling off the table, that expectation, at least in our work, tells us that was priced in perhaps in the fourth quarter. So while we're not necessarily negative on equities, we're certainly positioned here for equities to take a little bit of a pause here. And that's the way we're treating our portfolios today.
So, Mark, I'm curious about this, and I think it's a really important point, if not the most important, which is which market's pricing in what? Because maybe we don't have enough economic, surprise to push earnings to 15, 20% growth, but is the economy as sluggish to where we should be talking yield curve inversion again? I mean, the bond market seems to be, once again, either way out of line with what stocks are signaling, or then we've got some serious trouble in store or something. Because I know we were able to basically say, hey, stocks and bonds can look different, but that's when the Fed's got our back, right? Because the Fed will buy the bonds, and then the investors will buy the stocks. So if the Fed's not going to be active, then don't we have to choose which one of these markets is right?
You make a good point. So absent, the Fed's real and implied support, equity markets would probably be a little bit more difficulty here. So while the Fed's backstop is certainly given the market time to kind of recalibrate itself around slower manufacturing activity, a slowdown in earnings in 2019, and maybe we do get some acceleration in 2020 that benefits PE valuations. But it can't be overstated. The implied support that the Federal Reserve has given this market has kept it upright, longer than I would have expected. And if we do see a drawdown in the first quarter, we expect the implied support of the Fed to kind of make that drawdown fairly mild, at least in our.
Okay, and I think this is well said, because right now you've still got a roughly 80% chance of a cut this year that worked its way in to the market kind of quickly, basically over the course of like a month. It went from like 50 to 80%, then Mark, is the risk here then that I know that if we get to that level, then people are going to say, all right, we've got problems if the Fed's going to cut again. So investors should be kind of cheering, I guess, for the best case scenario, which is no cut to some degree, right?
I would think so. So, as I've mentioned, I think the Federal Reserve would like to do nothing this year. One, obviously, it's an election year. Number two, I think if they try to do too much too soon, especially tomorrow, I think is off the table in terms of any action whatsoever. But I would say that the bias is for them to cut rather than to raise. Obviously, I think they don't want to raise. In my comments in December, I implied that I see no action from the Federal Reserve. But again, if they do step in over the next couple quarters or so, that's probably going to be seen as good news from the market. Mm-hmm. But it depends on how they step in. If they're kind of extremely reactionary in terms of the way they go about it, I think that could cause some additional volatility. But the old adage, you can't fight the Fed, has been good to you over the last years or so. So I don't know that we change that in 2020.
So to kind of bring this back to that question, bonds versus stocks, I guess another way to look at that is the hypothetical. Let's say tomorrow the Fed Jay Powell sees this Fed funds futures pricing right now, and he says, I got to do something about this. We know they don't like to do that. They're not going to shake up the apple cart too much. But let's just say hypothetically he goes, you guys got to get rid of this cut this year. We're not going to do it. Economy's looking good. Look at the employment. Look at consumer action. Is that going to be more of a problem for bonds or stocks? Because I look at stocks, and there's a lot of cyclical stuff that's been leading this. And semis, I imagine they might like to hear a message like that.
Yeah, I think that in terms of bonds, we still expect the market interest rates to kind of grind lower. So, that's more of a structural issue. Obviously,
even from
the Federal Reserve has some
impact
over that.
At 164, still going to grind lower?
Still going to grind lower, Oliver. Yeah, I would fully expect that. And again, that's structural and perhaps a longer conversation. But obviously, the Federal Reserve has some impact of that. So I think if the Federal Reserve says something a little bit off script, as it were, tomorrow, that's probably more problematic for equities than bonds. I think bonds and the idea that we're going to get these sustainable higher interest rates at some point in time in the future, whether that's near term or intermediate, I think people should just shelve that concept. I don't think we're going to get it. And again, that's structural.